Hey everybody, Eric Hale here. Thanks for checking out another episode of the Everyday Trader. We've got an extra special guest for you today. We've got Lex Luthringhausen from Tradier. Lex is a former market maker, options market maker. He's got a ton of industry experience. And we ask him all of the hard questions that you probably want to know about how market makers work. Do a deep dive into his background and talk a little bit about some of the information that they use. And we talk about how this can help you out as a retail trader. There's information that could be helpful to you. But before we get started with the interview, I did want to tell you how you can find Lex. So Lex broadcasts his own show Monday through Friday at 10 a.m. Eastern Time on hub.tradier.com. You'll find the link down below, or you can go to YouTube, find the Tradier page, and you can find him there. I hope you enjoy the interview. Good afternoon, all of you everyday traders. This is Eric Hale with Trader Oasis, and we have a very, very special treat for you all today. Before we get to that, Greg, you want to say hello?
Good to be with everyone. It's still morning where I'm at, but wherever you're watching this, welcome. Thanks for joining us today.
Why don't you tell them what's so special, who we got today.
Well, we're excited to have one of our business partners, actually, that we've been working with for a couple of years, and the venture that we've started over that Eric's headed up over at Trader Oasis, and of course our partner is the brokerage firm Tradier.
This is Lex Luthringhausen, who's currently employed at Tradier. He's a former market maker. He's done a lot of different things, and we're going to talk about that. We're going to ask Lex all of the dark and dirty questions and try to understand, pick his brain and understand how that other side of the business works. But before we get there, Lex, I'm looking at the photo where you're at, and I'm seeing this background, and I am getting an evil villain vibe here. So, question, do you live in a lair, and do you have evil henchmen?
That's right. Lex Luthor. That's how I got the Lex is the trading acronym, right? So it just stuck for whatever reason. My nickname in college was Luther. So naturally, you need a 3-letter acronym on the floor to identify yourself. So someone said, "Hey, how about Lex Luthor?" I'm like, I like that. So
it's great.
It was available. It stuck.
So Lex stuck. So you're not an evil villain, and market makers are not evil people. And let's just get started. So tell us a little bit about background and what you've been through and how you got to where you're at.
Yeah, and Greg, I'll answer your question too about the Tradier luring me out. So, listen, I started the market making business right out of college. I was going to go to law school. My dad was in the business way back when and said, "Hey, at a young age, you might want to try this market making thing." This is when there were actual floors that people actually went to. So that's not necessarily true anymore, right? It's all electronic and hybrid sort of stuff now. So I said, "Yeah, what the heck? Law school didn't sound like any fun anyhow." So I linked up with a guy who would ultimately become my backer and partner down the road. He put me down there. He taught me some things, threw me down to the wolves, and I got going in it. I was a significantly horrible trader to start. I was a flame out when I first started. So the guy my backer had to put in a few more dollars to help me out. I don't know what sunk in, but I kind of started getting to be friendly with the pit a little bit, knowing the players in there and listening to what they do and trying to, mimic what they do. And finally, I stumbled upon something that really worked. And the rest, as they say, was history. I finally figured it out. I started making some money, bought myself out of that contract ultimately. And then he and I started another proprietary market making business. And that's where we got into the real specialist side of options, DPMs and market making.
So you mentioned specialist, market maker, and dealer. What's the difference?
So I'll start with the specialist part. So a specialist is a New York term. They tend to refer to their stock trading entities that are the primary, market makers in a listing. Okay, and they call them specialists. In the option world, they didn't use the word specialist. SIBO sort of brought that to the forefront. They called them designated primary market makers, which is DPM. So that's stuck in the options market making space. It was the same concept. You were a specialist in a series of products that were assigned to you as an entity or a person. And so that's the main difference. And someone probably is wondering, well, dealer, market maker, what's the difference? I got to be honest, we use those interchangeably.
Okay.
A dealer was brought to my attention fairly recently. It's a term that I think retail people studying the retail markets tend to refer to market makers as dealers. I use them interchangeably, though.
Okay, thanks.
Yep.
So who do market makers actually work for?
Well, nowadays they work for gigantic firms with billions of dollars. In the old days when I started, you either worked for yourself, you were a sole proprietor, you put up your own money, you had an account, or you could work for small groups back in the day. So, the whole deal with market making is you need capital, right? And when we first started, you didn't need a lot of capital because, you could be a small shop. They didn't have the regulatory and compliance requirements back then. They had them, but it wasn't as onerous as it became. So as the business evolved, what happened was there was more and more regulatory oversight and compliance and what have you. And then it kind of created a season of bigger money, accumulating and entities becoming the market making community. So the big boys survived, essentially.
That's the Citadels and the Virtus.
Yeah. So that's who most, right. So that's who most people were employed in a market making firm. They work for Citadel, Susquehanna, Wolverine, Group One. There's, I don't know, 10 of them left, as opposed to like 4,000 back in the day, or 6,000.
So let's get down into some of the
farming.
Yeah, farming.
I was gonna say it's kind of like farming, right? There used to be thousands and thousands of individual farmers, and now it's just a handful of conglomerate giants.
Yeah, I mean, it's in the market making business is about capital, right? It requires, essentially large sums of capital now based on how the business has grown so much. I'm sure you're going to ask me something about that, so I don't want to get ahead of myself. So
yeah, we get some questions about that, capital management and delta hedging and all that sort of stuff. But let's one of the questions that's very popular that got asked is how are bid ask prices set?
So what's required of a market maker, and I'll just use market maker as a metaphor for the individual, the entity, whatever. So anyone who's engaged in the market making business, they are required to post continuous two-sided markets in every class they're assigned to, in every option. Now I'm almost positive it's still the same. That's how it was when I was there. We had a certain percentage we had to quote in. The DPM or specialist has to quote in everything. They are responsible for liquidity, period. That's what they do. So they post bids and offers and everything. You can imagine doing that, open outcry without a computer, how tough that would be, right? And that's what we did when we first started. It was all open outcry. The way they make these bids and offers is very, I don't want to say very simple, but for them, it's very simple. They have a theoretical value profile of every single option. They've got surfaces for skew. They've got relationships between one expiration and another. Their models are set so that they don't get too much inventory at any one price. So their machines give theoretical values and they place their bids and offers around that value, because that's where their real edge is. Buying on bids, selling on offers, doing it thousands and thousands of times a day, and managing risk the whole way through, right?
So what I wanted to get is like some equities you look, and somebody this morning asked me a question about a uranium mining company that's trading for $5.50 and it has options. And the bid ask spread is like plus or minus 50 cents on. And so it's bid 50, ask $1. Like that's just crazy wide. Why is that?
So think of it this way. So the reason it's so wide is, market makers will behave according to order flow. So the greater the order flow, the tighter the markets. The less the order flow is, the wider the markets. They are in the business. Market makers are in the business of expanding on that bid ask edge model and mitigating risk at all costs. So if there's not enough order flow for them to get in and out of things, you're going to tend to see wider markets for them. They just don't want to be in the business of making a tight market for no good reason, because they're not going to be able to get out of it necessarily, right? So
that makes sense.
Those markets are going to widen, right? Yep. Sorry,
I was going to say that makes sense. An example I always like to share is, back on what lovingly referred to as Lehman Day.
Mhm.
I remember I had puts on the SPY, which by all means, of individual option instruments, it might be the most liquid one out there, or one of them anyway.
Mhm.
And because it was Lehman Day, I had an option that at the time when I had bought it was right at the money. It was a put option. It was now deep in the money. And I think I had originally bought it for like $4 or $5 right at the money. And when I opened up my account the day of Lehman filing bankruptcy, it was bid $1, ask $10.
Yeah.
And what makes sense is there's no order flow. The market maker is doing his job of saying, well, I'm making a market. It's a bid $1, ask 10, but I really don't. There's no one else trading right now.
Right. Yeah, that happens. In any sort of takeover scenario, and I lived through those. I was part of the Chrysler takeover way back when. When you have any sort of potential for a binary move in the underlying, because of news, because of whatever, because of market conditions, you name it, market makers are going to tend to widen those spreads out. And I know retail folks have seen that. You get some Fed announcement or the announcement's coming, you start seeing markets widen before the announcement. We don't know what's going to be said necessarily.
Mm-hmm.
And if it causes a real disruption in the marketplace or any individual stock, market makers are going to prepare themselves for the worst, because they can't go away. There's no coffee break. They can't close their shop up and say, oh, I'm going to go have some Starbucks now and you guys deal with this yourselves. In today's world, they are required to be there as long as the market's open every second of every day. They have to be making continuous markets. And, quite frankly, they have rules that can be wider in certain conditions, right?
So that might lead to this next question that I wanted to ask you. In certain conditions, we're talking about volatile markets, wide spreads. Is this kind of the basis for where implied volatility comes from? What is implied volatility, and
yeah,
how's that going to option pricing?
Yeah, so it's probably there's like 5-ish metrics that go into the model, right? And the least of which is probably dividends and interest rate. Although interest rates have become something new, right? Something new and exciting because they're so much higher. Implied volatility is the toughest one to get a handle on. So where the market maker has a little bit of trouble, probably not so much anymore because of all the systems that are out there and the ease of mathematics. Is making a market in a new listing. So we as a firm back in the day got Google as one of our listings. That was what we were specialists in, or market prime DPMs in. Google hadn't traded. It was a new listing. So we have no idea what implied volatility to append to the option model to price options. We just guessed back then. So we try to compare like sort of companies, to Google and feel what the implied volatility was there. And implied volatility is just a metric that the options are implying about the movement of that underlying. Okay, that's what it is. It's telling us a story of what the marketplace perceives to be the movement potential of that underlying. Now, movement can be up and down and finish unchanged, right? Which doesn't seem like a lot of volatility, but you have that intraday move up and down, which could be, great. So market makers have to protect themselves for that. So market makers will raise implied volatility when demand for options grows. When people are only buying options from market makers, they're going to raise their prices. These people and these corporations or entities are not stupid. They are the smartest people in the room by far. They know every little aspect of this, and they will change this like that. It is quick to move as needed, because think of it this way. And I hate using this analogy because it makes it sound like it's gambling, and it's not. Market makers are like sports books, right? Sport books don't make their edge by hoping everyone bets the wrong person. They're going to get two-sided liquidity. The sports books are. Someone's going to buy too much. What does a sports book do? They change the odds. They raise them. They do something so that more people are selling that bet. And now all of a sudden the book has a hedged book of, people who bought, people who have sold, and they're trying to make the middle. It's all a market making firm's doing. They're just collecting edge all day long. They don't want to have much inventory straggling out there whatsoever. So they're going to raise implied, lower implied, which is going to affect the price of those options, right? Does that make sense, Greg?
It's a very important point, because that gets to how do market makers make money?
So they make money, I've spoken at your event a couple of times, I give an example of a bid and offer, right? I use a wide one. So let's just say it's $1.50, just to make the math easy. And their value is $1.25, right? Market makers are constantly paying $1, selling at $1.50, hopefully all day long, right? Now, spiders, there is no 50-cent markets, they're penny wide, right? So they may only be on one side and someone cuts in front on the other side. So that's pretty common. But market makers aren't trying to accumulate inventory necessarily. When we traded, if I could pay $1 and immediately sell it for $1.50 and my bank has no position in it, I've made that 50 cents, sign me up, I'll do it all day long. Okay, that's how they make their money. They're always buying edge and selling edge, and they're doing it continuously all day long with thousands and thousands and thousands of trades. They're just picking up nickels and dimes in front of a steamroller. That's all it is. Occasionally they're wrong. They get stuffed with inventory they don't want to have. They can't get out of it. They can't hedge it very well. And you get a big move with a wrong position, you lose money. It happens. It happens. But just like an insurance company, Warren Buffett Insurance, Berkshire Hathaway, he sells premium. He sells insurance, right? There's going to be an occasion when someone's going to make a claim and say, hey, my roof just got damaged. I need you to pay me. And Warren's going to write a check and he's going to pay. He loses. But like insurance companies, they're like actuaries. We do things on the market maker side that are very intelligent around moving that inventory so that we don't get just clomped down with too much stuff at one price. They're very agile about moving that inventory around. And they don't want to have it if they can avoid it, right?
Excellent. So there's some other questions that came up there that are interesting. We'll dive into a little bit deeper, but I wanted to get to some of the myths that are out there that that market makers. What's your response to the comment that market makers manipulate prices?
It's not true.
Not true. Okay.
No, I don't think so. So again, when a market maker posts a price, it's out there for the world to trade on. Now, what people might be referring to is that prices move quickly in certain instances. Again, that's the community of dealers and market makers moving their inventory because they're getting overwhelmed to one side. So when they get overwhelmed to one side, they're going to move it, and they're going to move it fast. And it's going to feel like they're manipulating, but they're really not. They have no interest in manipulating prices to the detriment of the retail trader whatsoever. There is absolutely no value for a market maker to ever disenfranchise a retail trader, because that's how they make their money. Quite frankly, I hate to say it, but that's how they make their money: bid, offer. That's it.
Yeah. So I hear retail traders sometimes saying that I'm getting screwed by the market maker, and I don't think that's true. I mean, what's your thought about retail traders? Is that, I don't think you can be in a business if you're out trying to screw over your customers.
No, don't forget, the best scenario is a retail person, or any person for that matter, buying a market maker's offer and selling his bid. That's the best scenario. That's what retail traders typically do. And you and I've had this debate before about clicking on the offer to fill a buy leg. Who the heck does that besides a retail person? It's not negative. It's just how they have to enter the market. And I always say that they probably have to give up a little edge to get into the market, a retail person. And that's why I really stress for retail folks, make sure you're looking at things that are really liquid and really tight. You give up less money getting into the position and getting out of it. Market makers are different. They want you to trade on their offer. They want you to trade on their bid as much as you possibly can, and they're willing to pay you to do it. So it's crazy, right? It's crazy, but that's how they do their money. And if they try to disrupt that train, that's their business. They don't want to do that at all. So they're not manipulating anything. All they're doing is protecting themselves and managing risk. And if it looks like manipulation, it's them moving inventory around and changing prices, just like a sports book might do, right? When they get too one-sided.
So I'm going to kind of follow along that idea with another question.
Sure.
That's back towards retail traders. What are some common mistakes then that you think you see retail traders making on a regular basis?
I think there's a few. The one that I see the most, I suppose, is they don't have a trading plan, let's call it. And what I mean by that is, a very defined entry idea, a very defined exit strategy, and most of them lack discipline to stick to that trading plan. Now, I don't know how you guys teach, relative to that. My guess is you're pretty tight on it. But if you don't have that sort of metric as a retail person, you will find yourself in trouble because you are already giving up some edge to get in. You're already negative edge to get into the position and get out of it for that matter. And most people say, well, I get the offer sometimes when I put an offer out. No, you don't. You know why you get the offer? Because it's now their bid. That's why you get the offer. You think you got it, but you didn't. Their machines are so much faster than yours, you can't imagine. So they're not getting any edge there. But, all hope isn't lost. The retail folks need to have a directional bias so that they can take advantage of that directional bias. And it can be neutral too. It could just waft with options. It's beautiful. So they make the mistake of trading too wide of markets that aren't liquid, and they get themselves really butchered. They have a great profit. And they're like, oh, how am I going to get out of this? I'm going to give it all away to get out. That's mistake number one. Not disciplined. They don't follow the trade plan. So that's kind of mistake number two. And I'd say, this is a preference of mine. Options are wasting assets. Theta is vital. I didn't really make real great money, even on the market making side, until I understood the value of positive theta. Now, that doesn't mean just go out and sell strangles and sell straddles unprotected. I'm very much an advocate of risk defined, theta positive sort of strategy. And I think most most retail folks, they start out and say, oh, it's easy. I don't have that much money. I'm just going to buy options. And they say, what the heck happened? The stock went up. I was long calls and I lost money because the calls went down. That's just the weight of just theta and any sort of vega that might be at play. So you've got to, I think you got to develop some ability to harvest theta. Every time I say harvest theta, I have to hit the bell. So it's a habit.
Hey, springboarding off of Greg's question there.
Yeah.
What's your thought on market orders? So people can put in limit orders, good to canceled orders and limit pricing. What's your thought on a market order? So what is a market order and what's your thoughts?
I hate them. For being on the retail, brokerage side, I hate them. They're always filled at horrible prices, unless you're trading spiders, right? Spiders are penny wide, size up. So maybe you can make a case for spiders, maybe Apple, the markets are tight enough. Tight markets, okay, but you're still going to get nailed a couple times. If things go nuts, you're going to get nailed. Now, someone says, well, Lex, I'd rather get nailed and get a bad fill than no fill at all. That's a good point. You got to tell me what your goal is, right? As the trader. I'm not a huge fan of it. What I like to do is use a limit order with a lien. So if I'm selling something, let's just make it up. I'm selling at $1. I'll sell it at $1 limit with a dime lien. So I can go down to 90 cents and hopefully that fills me. At least it's not infinity, right? With market. So, that's how I feel about that.
So to be clear, a market order is just whatever the market wants to give you. And if it's not a very liquid market, then you can get caught in the crosshairs there.
Yeah, you shouldn't be trading in illiquid stuff, first of all. And if you're going to use a market order in a liquid stuff, you are not going to like the fill. It will not be pretty.
So that's where somebody might feel like they got screwed by the market maker.
Yeah, possibly.
It's not intentional. It's kind of your own mistake.
Yeah. Well, think about it on a spread, right? If you have 50-cent wide markets on 2 legs or 4 legs for that matter, how bad that fill could be. Yeah. Crazy. It could be horrible. Right.
Mm-hmm.
Yeah.
So you brought up theta, which is one of the 4 main Greeks, right? I know there's a whole flow and Vama and Vana, and you can get into a lot of derivatives of derivatives, right? But I know a lot of our traders, a lot of people that follow us here on YouTube are familiar with delta. We use the term delta a lot and talk about delta hedging. Can you expand on maybe how some of the market makers, someone in your world uses those Greeks, whether it's and like you said, you use theta as a key thing that helped you understand, but do you use gamma and delta and theta and vega as helping you determine your risk exposure as well?
Yeah, we do. So on the market making side, we would use all the main Greeks, even out to rho. right? Which is interest rate exposure. We even use a little bit of dividend exposure too in the past. But and there was one other one that wasn't really a true Greek. We sort of started looking at it and created one of the Greeks that isn't really a Greek. We call it tilt. So it's how much skew we had in our inventory. So, calls over puts, puts over calls. So we would look at that as well. But we would use them all. And again, we'd always try to be neutral, especially with deltas. We didn't want to have directional bias. Small deltas, 1,000 here, 1,000 there, that was nothing. But we would not be unhedged delta wise at all. Theta came with the inventory that you were given. If we got long too, if we were paying too much theta, or collecting too much is kind of like, how can that be bad? But then with big positive theta, you're going to get big negative gamma potentially, in which case now you have real delta exposure when stocks move, because you always have to be, buying when it's running up, selling when it's going down with negative gamma. So we would just keep trying to balance all that stuff out. Now we would let theta run as best we could on the positive side. If it were negative, we would start selling options to reduce that to a level we could deal with. Okay, so again, it's a constant hedge. We would have a whole Greek profile on any position, and we'd see every Greek in every position. It changes tick by tick. We would just make sure that was all in line. Harder to do Vega, but still very important to us. We would have longer term options in the inventory, and we'd have to manage that Vega very well and very keenly. And sometimes we do things in indices to hedge individual equity stuff where we got too much dispersion across Vega in a lot of different stocks.
So buy an S&P 500 futures or something?
Yeah, or the S&P, SPX, OEX back in the day. We might use hedges there, but typically we were pretty good at hedging things.
And nowadays 0-day expiration options, right?
Yep. Yeah, they have those. They have them every day. Let's say there's a 0-day every day in SPX. So yeah, you can sell stuff until you're happy every day.
Yeah, let's not go down that path. We'll say
right.
We can spend an hour talking about
that. That's right.
But we want to stick with the Greeks. So you went through. So how do you touched on how you manage your risk? Can you talk a little bit about the concept of delta hedging?
Yep. So what we would have typically as a firm, I'm trying to think, as a firm, we had a lot of, market makers scattered out around the country, the globe, and we would let them manage their own books. And they had, the market, and we would obviously have risk management oversight into them, right? They would typically develop a style, I'd say. Some people like to be long gamma, some people like to be short it. It was just their particular style. The ones who were long gamma, you had to delta hedge and scalp your gamma, frequently to offset that theta. So what that means is, we start the day at 0 delta. If you're long gamma, right? And the stock runs up, whatever that long gamma component is, it's making you longer deltas when that stock's running up. So we would sell stock or options or something to get flat at that new price. Right now we're flat at the new price. If it came running back down, right, we get shorter and we buy something back to typically stock. So we're scalping that gamma as best we could, right, intraday, all week long to try to offset that heaviness of negative theta. Conversely, on the negative gamma side, you'd also have to pay attention. When it runs up, you're getting shorter. Okay, at some point you're going to have to make a decision to buy some deltas in, thinking that, hey, if this keeps running, I'm going to get in trouble. So we keep buying, try to whittle that delta down to the upside, and then whittle the long deltas in negative gamma positions. When it runs down, we're selling stuff. We're selling stock. We're buying puts, selling calls, whatever we can do to kind of keep that in check. So that's what typically happens. And my backer was a big long gamma person. He taught me that method, and I tried it, and I sucked at it. It was really hard. He was just brilliant with it, and it worked for him. But I was much better the other way, being short gamma, positive theta, collecting premium, little bits every single day. Much better at that.
You talked about this delta gamma theta, or delta gamma and rho, and how important those are, or delta gamma and theta, yeah, and how important those are. Can retail traders learn anything from understanding what the dealer exposure is?
Yeah, so your platform, the Trader Oasis platform, has a component in the volatility container that shows dealer exposure. I would say that it's probably beneficial to look at something like spiders, a macro sort of indice. Yeah.
There's
So,
Apple.
Yep. Yeah. So what's great about this is it tells you what the dealers are holding. And then what a retail person can learn from this is based on what I've just talked about, the questions you guys are asking about how dealers behave with their gamma. If they're negative gamma, like in this first example, the top left one, they're negative gamma on that red line pretty heavily. And it looks like about what, the 170 line there, more or less. So as the stock starts, fluttering around that number, if it starts breaking down and they don't have any other exposure to cover that, they're going to have to start selling stuff. It's going to start accelerating that move. Same to the upside. Once they hit the long gamma spot in that graph, now all of a sudden they're in control again when they get to the long side, and then they can start selling as it runs up and buying it when it runs down. But they have to manage that inventory. And I love seeing where the dealers are holding inventory. If I see negative gamma down there, there can be some flex points that's going to cause them to push it even harder and further down with some velocity potentially. And it depends on notional, right? Which I don't think we show a ton there. I guess we do a little bit. So yeah, I mean, the bigger that line steepens down, the more they have to cover, right? And there can be some pretty crazy moves around those negative spikes. We did a little piece on our show. There was I think it was a 4,200 in the SPX, was a big surface. So that was interesting. And it kind of, we've had this kind of volatile sort of interest all of a sudden, in the market. So that became a flex point too. And we kind of started pushing near that. So, but I use this a lot. I really do.
Well, I found this to be a significant help in structuring the specific trades that I do, because, well, first of all, that a lot of people, when they get the understanding of what gamma is, so this reflects how the dealer gamma is. Now, dealers don't want the stock to move. They'd be happy if the stock stayed where it is, and they don't really want it to go up or down. So the analogy that I use is it's like having a pile of dry kindling, some gasoline and some matches. They're all okay, right? There's no problem until we do something. It's the same thing when the stock. So in this situation, let me review what you said, is this is Apple, and right now there's pretty significant negative gamma to the downside of where this is trading. So what that means is if the stock goes down, that's a negative movement, and a negative movement times a negative gamma means that the dealer's delta is going to become positive. A negative times a negative is a positive number. And so the dealer who wants to be delta neutral, they have one choice, and that is to sell the stock.
Yep.
So if the stock goes down, it's likely to make a pretty accelerated move down. Now, to be clear, this is not telling me any sort of directional bias. It's just if it moves, it's probably going to make a pretty significant move down. And that the way that and to the contrary, on the upside, because you've got positive gamma, if the stock goes up, the delta becomes more positive. So as you said, then in this situation, if it goes up, they have to sell stock too.
Yep.
So what we get is a dampening force to the upside, but an accelerating force to the downside. And again, this is not, the market makers are not manipulating the markets. They're just responding. And how significant is that? I mean, what percentage of the volume for the day? Can the market movers move the market?
Yeah, it depends on the notional amount that they have, but you could see notional amounts in the hundreds of millions, which is a big number, right? So all of a sudden that becomes really, really interesting when it's that high. So, when you get pretty big numbers, and we have another system, it's not part of this one, that shows that it can be amazing. It really can. And you can get some pretty volatile, high velocity sort of movements, right?
Let me compare this to a different equity. So this is Apple. And I think when I look at this chart, I tend to see that the moves down tend to be bigger than the moves up. And if I contrast that to another equity, and if I pulled up this chart and I didn't tell you what it was, you would probably think it looks something like maybe the VIX or something. It looks like a volatility indices. You've got these huge spikes up. but this is an equity. This is SoFi. And if we look at the volatility on SoFi, Lex, can you explain to me what you see in the dealer gamma here with SoFi?
Let me take myself off mute here. You have the first 2 months check. Yeah, so the dealer gamma to the downsides looks pretty positive, right?
Right. And so if the stock falls, it's probably going to find resistance, or
It will. Yep.
And what happens if the stock goes up?
Well, this is a GameStop representation. Okay, this is
SoFi,
exactly what happened in GameStop.
Not GameStop, but
yeah, I know that. I'm not saying that. Don't start buying this stuff. I'm having background noise, guys. Sorry.
I can't hear it.
Okay. So yeah, this could be a interesting move to the upside if something comes out. Boy, and again, if that's a big number, the dealers are going to chase that baby to the upside.
Right. I mean, when you look at a stock chart like SoFi, this looks different than a normal stock chart. You get these massive spikes up. And for me in my trading, if I place a trade, if I place a bearish trade, I got to be cautious about potentially this move that may go against me. So, for example, a bear call spread, a credit spread on calls, usually you have bigger risk than the reward. So I would be careful on that. On the other hand, if I place a bullish trade, I don't want to do a credit spread that's going to limit to the upside. I'm going to want something that if I get this move up. The other thing I can take away from this, if the big move up happens, it's going to be there. You got to take profits right away because it's probably going to come right back down. And this volatility data, this dealer exposure, and we're not talking about Vana or Charm yet, but that's probably another session. But this dealer exposure has been critical for me. I look at it at every trade that I place. Because it really helps me determine how to structure my trades.
Yeah, it's a good tool. It really is. You can absolutely, use that to find levels. I love that. That's a good use of that.
Yeah, thanks. Let's see. Greg, did you have any other? I got a list. I got some more questions. Any comments on any of that, Greg? Or
well, you kind of answered most of it for me as far as that goes. I know a lot of our followers are going to say, "Well, I can't replicate what you do. How do I? Is there technology that helps me keep up with this?" And I know we've been showing the Trader Oasis platform, and which is obviously executes all these trades through Tradier. Can the retailer do this, or do you have to be a market maker to trade like this?
No, you can. So what's great about having that tool is you can see where the dealers are exposed. It's almost like, I don't know if you guys are card players or not, but it's almost like seeing a quick glance at one of the whole cards in the Texas Hold'em game. When you see something that gives you information, you're in a better place. Right. Sure. So that's how I use it. I use it like Eric uses it. So I would tend to structure things based on what those gamma levels could be, assuming they're big enough, and to use options to take advantage of those inflection points or lack thereof. Right. So that's how I would use it. Knowing, and Eric, you made an important comment, knowing that, you've got to be on a short leash on those things. If it busts through, there's no more hedging beyond that. Right. So you don't know what happens beyond that. We don't know yet. There's going to be a reestablishment of a hedge because people are going to pound in, and now they're going to give the market makers a new position at a new level, right?
The other point on that dealer exposure, I found that it gets weird on Fridays and over the weekends, and that's because you've got people closing a rolling position. So I find it better to look at it, late after the market's opened, halfway through the day on Monday, all the way through to Thursday. I find it pretty useful. On Fridays, things get a little bit weird as they should, as traders are closing their positions and rolling them. Let's switch gears and talk about market dynamics. And you touched on it, like a Fed meeting coming up. So you got a major news event that's coming up. How do market makers prepare or respond when there's a significant event, maybe a big earnings report or a Fed announcement?
Yeah, I mean, we obviously had to trade through earnings, right? It's not I would say it wasn't my favorite time. I probably would say on earnings, big earnings moves, we probably had the wrong position on a lot as market makers. I mean, just us. Everyone's clamoring for options. You are doing an analysis of a expected move sort of thing. You can look back in time and see what those were and kind of price options that way. But, the problem is that, NVIDIA did this recently. Remember that big up move it had for the last earnings?
Yeah.
It kind of hit the upper level of what was expected based on the straddle.
It
right?
did. Yep.
So then from there, it kind of dripped its way down to almost unchanged on the day or thereabouts. And that straddle, if you had it on and were able to sit through it as a market maker, which you probably wouldn't, you would have made a fortune selling it. But, do we play that game? No. Because you know what I'm doing when it's up $35? I'm thinking, okay, what's to stop it from being up $55? I'm covering, right? So those were not fun times, especially when you got a pretty big move and now you got to make a decision, which you probably know is going to be a bad decision, but you stay disciplined. That's the point. And we were the same way. We didn't think about it. We just did it. So.
Hey, you mentioned something that I think a lot of people are interested in. You talked about expected move, and we have in the platform built in we can calculate plus or minus standard deviations using logarithms. Mm-hmm. I find that, well, let me let you answer the question before I tell you my thoughts on it. But how do you talk about expected move? How do you approach expected move? What is it? What is it? And how do you approach it?
Yeah. So again, it's what the options are implying, right? And the way implied volatility works to everyone, in the marketplace now is it's an annualized number. When you look at implied vol, it's an annualized number. It's saying that, 20 vol is going to move 20% on average over the course of a year, right? You've got to take that annualized version and get into a 1-day standard deviation or 1-day, expected move, right? Mm-hmm. The way to do that is you got to divide the metric by the square root of time. Okay, I don't want to get too mathy here, but you got to divide by the square root of time. So the typical number is the rule of 16. It's really 15.87. So to get to an expected value, you take the implied volatility in its decimal form times the stock price, okay, and divide that by that square root of 252, which is 15.87. Whatever that number comes out to be is your expected daily move. Okay. And again, you've got to use a good implied volatility. So if you're looking at, some big earnings, pre-earnings kind of number, it's going to give you a pretty good flavor. Some people argue, well, the straddle does that pretty well too. It does.
What do you mean by the straddle?
So if you look at the price of the straddle on the day, day before earnings with the near-term expiration, it'll give you a pretty good approximation. Whatever.
So the break even on the straddle.
Yeah, it'll tell you
the market is pricing in.
Yeah.
So to be honest with you, that's what I end up using is just.
Yeah, it's fine. You look at it's not brain surgery here. You don't have to get the exact number.
Right.
You got to be kind of close, right? So the straddle is a perfect, number you can look at easily. You don't have to do high level math. You just look at the straddle and say, oh, it's a $30 straddle. The community's thinking about a $30 move here, and it's probably not exactly 30, but thereabouts is fine.
I found that to be good enough for me because when I break out the calculator and start doing square roots and decimals and logarithms, I don't find that I get a better answer, and it takes more time. I can literally look at option pricing in a half a second, get a feel. And I think that's one of the things that traders who have experience get a feel for. Yep. And I'm sure you could do it off the top of your head. I'm betting you don't break out the HP 12C and start.
Only to make sure I know how to do it still.
Right? Or do you do it in your head because you're like Rain Man?
I don't know about that, but I don't look at that anymore. I don't look at it a lot, I should say. I look at that straddle for the most part. Just get a thumbnail. Again, this is orthopedic surgery. No offense to orthopedic surgeons versus brain surgery. Just get close,
So Eric, I know you got a lot more questions. I don't know where we're at on time, if we've got enough time to go through a few more, but I had a couple questions about, kind of going back to the retail trader. Mm-hmm. So if we can do this, what advice would you give retail traders on how to learn it, how to, tools they should be using, things they should be looking at? What advice do you have for retail traders?
So, my biggest advice is join the Trader Oasis community. Okay, first of all, you have to learn from an expert, and you have to learn from someone who knows what he or she is doing, who isn't a market maker. Okay. I'm not trying to bash market making teaching. You know, we teach very specifically, and it has very little to do with the retail trading environment. It's completely the opposite, quite frankly. So I couldn't sit down and teach my market maker stuff to a retail person and say, hey, good luck, you're going to do great. They won't do great. You need to have a firm, and I say directional bias. What I mean by that is you have to have an opinion of, is this stock going up? Is it going down? And a reason for that. Okay. Additionally, you can have opinion that nothing's going to happen and set up an option strategy as well. But you have to have some sort of basis in a little bit about direction. And most of the educators that I see in the retail community, they tend to be really good at reading charts, which we were not good at. They tend to be really good at understanding maybe some fundamentals about a company that we didn't do. We had no idea what our companies did because we didn't care. We didn't care about direction. So those sort of things can really help you. I had a great conversation with a friend of mine who asked me a question about cash secured put. And he wanted to keep rolling this put out, and he was getting close to getting assigned on it. And he told me, you know what, the biggest thing that resonated with me, I want to own this stock. I believe in it for XYZ reasons. I did my homework. It's a great stock to own. I know it's getting hammered because of the market and interest rates, blah, blah, blah. And I want to keep doing this trade. That's good enough reasoning for me. That makes sense to me. He's done his homework. He understands why he wants to own it. He's willing to take delivery of it, and he wants to make sure he's rolling correctly. Those are all good points and good questions. If you don't have some sort of plan like that, and you're just looking at the screen, you know, what are you going to do if you're looking at the screen? Am I going to buy these or sell these? You're going to look at high volatility or low volatility, you know, right? So you have to have, it really helps to have a little bit of a directional bias of some sort, I think. And then from there, be very risk defined after that. And I'm a big premium seller, but you know, that's me. I can collect my premium on the weekends when I'm having cocktails and steaks. So it decays on Saturday and Sunday too.
Yeah, theta is like rust, right? It
like
rust never sleeps. So theta decay happens 24/7 over the weekends. Right. Thanks for the plug. And I'll say, you know, Options Animal does a great job at educating people. That's our education partner, and the trading partners at Trader Oasis.
Yep.
And we do approach things a little bit differently. One of the analogies, I actually heard you and another market maker talking about, quote, the worst trade in the world being a covered call. Yeah. And there was a Barron's article in February that talked about it. This was actually written in Barron's, that the risk of a covered call is if the stock goes higher, which makes me laugh because that's where the maximum profit is. Right. And if you sell your stock and you are making a decent return, it's not uncommon to be able to make 5 or 10% in a month. And if you can make 5% in a month, that's 60% annualized return. Right. You know, why not take your profit? You know, you have to deal with assignment, or maybe you could close the trade early for slightly less than max profit. But I don't have a problem selling everything that I own for the right price. And I think that's where the difference is, in market makers manage their portfolios completely differently than retail traders. And I think the biggest mistake retail traders make, and you alluded this to in the beginning, and that is having a plan. The biggest mistake they make is they don't have any goals, or they don't have any plan, and maybe they're not sure why they want to do this. But getting into a covered call, I mean, we use the covered call all the time, and we do in the money covered calls and sell it lower than we buy it, but we end up making a decent profit with a high probability. And in that situation, we're being the insurance company or the casino or the sports book. You know, the odds are in our favor of making money. Sure. We do have to worry about the liquidity and the bid-ask spread, and that's why that's so important. But yeah,
I'm a fan of that, by the way. I actually, in the retail world, I love the covered call. Especially, you know, it's an income generator, right? That's the idea of it. And you're not gonna, you know, I'm assuming that if you own the stock, you don't think the stock sucks. You think there's some value to the stock holding its value or going higher, maybe slightly higher. But you're not in the position of saying, wow, this stock really stinks. I can't wait to get hammered on this covered call, right? So you have a reason for it in the first place. So I like it. I do like that. Yep.
I got one other question before we wrap up. I really appreciate your time, and I know we're getting a little bit long here, and this has been awesome, by the way. So I really appreciate you and I have had these conversations before, but I think our audience is really going to appreciate learning here. I want to talk a little bit about dividends. So can you talk about what happens when ex-dividend date approaches, And is there a trading edge can retail traders take advantage of that?
No. So people think it opens, stock opens down by the dividend. That's all computed into the whole equation, right? So you don't gain money, you don't lose money. You're going to get paid if you're long the stock before that X date. You're going to get paid that dividend, right? So it's going to make you whole. Conversely, if you're short that stock, you are going to pay out that dividend, so you're not gaining any money there. You have that fake gain, and then you're going to pay a dividend to offset the exact.
The calls are going to go down, right?
Yeah. So yeah, the calls are.
Are they going to go down?
The price is already built into the options.
It's already priced in.
It's already priced in. So if you can play a game, I'm trying to think. We don't do this in the Trader Oasis platform anymore. We did it in the first version you guys had, but you could play a game where you could put in a dividend and look at the value of the combo, which is the call and the put. Okay, they get out of whack, right? Because it has to measure the dividend. If you take the dividend back out, it goes back to the parity of the underlying stock. And there's a little trick to it. It's hard to explain without drawing it. We'll do that maybe at a seminar or something. But there's no edge for the retail trader. They're not getting an edge at all. It's not happening.
Right? Yeah, I've tried for many years, knowing that stock price is going to be adjusted down, somebody pays a dividend, and so that puts theoretically should increase in value and calls should go down, but it's already priced in. So there's no such thing as a free lunch. There actually is a free lunch that's on the professional side of it that has to do with how the difference in clearing works.
That's right. Yeah,
but that free lunch, and I think I spent a lot of time trying to get my head around that and realized it was a big waste of time. So trading around dividends, I think the only edge that you can have is if you can kind of guess ahead of time. And actually sometimes I'll do in the money cover calls hoping that I get a sign to sell my stock. Because when the dividend is paid, if somebody wants to capture the dividend, they might exercise a long call to be able to do that. And so I think there's very little option for retail traders opportunity there.
Yeah, it's tough for the retail folks. What we used to do, there were dividend plays we did in the day for big enough dividends. And the only goal in the dividend play was to trade a spread that had two exercisable options in it, one being a long, one being a short. So you could take both sides of it, right? And hope that you don't get assigned on the short part of it so that you escape the dividend, and you collect that dividend on all the ones you exercise. You have to remember to exercise the ones you have, right? And you get all this long stock, and the ones you miss out on that people forget to exercise, you make that dividend, you escape it. So that was a big play in the market maker community all the time on the big dividend stocks. But you can't do that as a retail person. No one's going to let you do that, right? Because you got to do it for like a $5 box or a spread. It's got to trade for about $5. And market maker community is going to look at your $5 and go, we're not going to trade that. You got to pay me 5.25 or sell me at $4.75, and then I'll think about it. So yeah.
Great.
Hey Eric, you said you would sell anything you owned. I'm thinking specifically of Mark Grace jersey that I've seen you wear.
Ooh.
You got a price on that one?
Yeah, it's an official, actually game-worn
Mark
Grace
That's what I'm saying.
jersey. I would sell that. I've got my not a flamethrower. I've been able that list. I saw it on eBay for $4,500. So I maybe I'll sell it for 10. I'll sell it for 10.
Oh, there you go.
That's my Elon Musk boring company, not a flamethrower back there.
Cool.
Say before we go.
What's that?
Before we go, playoffs just started.
Oh.
So I'm condolences to the Cubbies not quite making it.
I know we're heartbroken over here.
It was close.
It was. They blew it again.
So who do you guys got?
I'll go with the Dodgers for you.
For me,
all right, I'll go for the Dodgers too. I don't have a horse in the race anyway. I don't care.
Not Atlanta. No,
I'll root for the Dodgers.
I wish I could. I obviously I'm pulling for the Dodgers. The Braves are really good this year, so
they are.
Well, we'll see if
they did us in, right, Eric?
Man, this beginning of the year they were terrible. So far below 500, I gave up on them, and then almost gave up on them. Cubs fans, they never give up, but man, they came back and just were so hot, and then just faded towards the end. Couldn't get past Milwaukee. It would have probably a good thing. Probably would have broke our hearts in the playoffs anyway. So
yeah.
So hey, listen, interesting this, but just do you have any final thoughts or anything we didn't talk about? Anything that you'd want to share with?
Well, no, I don't. I don't think so, because you guys are really thorough on this. I thought these were great questions. I appreciate that. I'm just trying to dispel rumors about the market making community. They really love retail folks, and they don't want to hurt them at all. That's their bread and butter, quite frankly.
I honestly, I tell students and clients that we should be sending thank you cards to the market makers. We should appreciate them. Again, if we do something stupid, they're going to take advantage of us. But if they didn't make markets, we couldn't trade. So we should be appreciating them. And if somebody got screwed, it's probably if something bad happened, it's probably you're on you. You probably own it, not the market makers, because they wouldn't be in business if they were hurting their clients.
Yep. They need paper and order flow. We call it paper, but it's order flow, right? That's what they need.
Great.
Well, Lex, we appreciate you joining us.
Thanks, guys. Good to see you guys.
Yeah, good to see you as well. And
good.
Look forward to seeing you live at another event sometime. We'll have to
happy to do it. Let me know. Love it.
I just want to say aloha, Greg.
Hello. Ooh, that would be a good one.
Maybe.
All right, everybody. Thanks. I appreciate it. We'll catch you all later. Thanks for attending.
Thanks.
See you. Bye, everybody.
Bye.